Let's talk about the fear index. That's the VIX, the VIX. And what this is just a measure of the market's expected near-term volatility. And again, we call it the fear index. And it tracks the 30-day implied volatility of options on the S&P 500. And it provides an indication of the investor's expectations for volatility over the next 30 days. So basically used as a investor sentiment gauge. And we can assess the level of fear or stress in the stock market. And the popularity of using the VIX has grown a lot since it was introduced in 1993. And it's actually the most commonly quoted measure of implied volatility. So a high VIX reading indicates the investor's perceived heightened risks. A low VIX reading just essentially indicates that investors are feeling a little bit more optimistic about the future. So how does it work? So again, we use options prices on the S&P 500 stocks, okay? So it looks at puts and calls from across a range of strike prices and expiration dates to determine the volatility. So this means that when option premiums for puts or calls are higher than usual, this indicates that traders are expecting higher levels of volatility in the near future. The higher the VIX will be. So we can use it as a tool for determining whether we should increase or decrease our exposure to riskier assets like stocks or commodities. So when there's high fear in the market, when the VIX goes up, this usually indicates that investors are selling off risky assets a little quicker. On the flip side of that, low fear, so low VIX, investors tend to buy these risky assets. So if you can understand how fear affects markets and trading decisions, you can make better decisions about where, when, and if you want to invest your money. So additionally, got to keep in mind, the VIX provides information on expected future volatility rather than actual stock performance, right? So you can use this information as an early warning system for potential changes in the conditions of the market before it actually happens. Trading the VIX has actually become pretty popular over the past few years due to the ability to provide insight into market trends, but you cannot directly buy or sell the actual index itself. Instead, you have to use derivatives like futures contracts or options on futures to gain exposure to it. So when you trade these types of derivatives, it allows you to profit from movements in either direction without having to physically buy or sell shares of any underlying security. And additionally, these types of contracts are generally leveraged, and that means you will have more buying power than you would if you're just trading stocks directly. And the most common way to trade the VIX is through futures contracts or options on those futures. So the Cboe, Chicago Board Options Exchange, it offers two types of futures contracts for trading the VIX, monthly and weekly expirations. So these contracts track the movements of the VIX spot price, and that means that traders who buy and sell these contracts can benefit from changes in volatility without having to buy other stocks or investments. You can also buy options on these futures contracts. So that's going to allow you to take advantage of more complex strategies like straddles, strangles, butterflies. Cboe offers ETFs, and they are also designed to track the performance of the underlying VIX index. So these ETFs are going to offer you another way to participate in volatile markets without having to be in stocks. So let's talk about levels. So the higher VIX reading, as mentioned, it's greater uncertainty. Levels above 30 indicate tremendous uncertainty. So you can use the VIX to hedge downside risk by buying put options when the VIX is relatively low and premiums are cheap. So an average level of the VIX is around 21.4. Higher readings above 30 usually associate with bear markets and increased levels of volatility and fear. So does the level of the VIX affect option premium and prices? Well, the higher the VIX, the greater the implied volatility. So this increase in implied volatility leads to an increase in option premiums. That's the amount you're going to have to pay for an option contract. So higher premiums means that you're going to pay more for both buying puts and calls, but it also means if you're selling them, you can get more money for them. In addition, with higher VIX comes a wider bid-ask spread on contracts, and that's going to increase transaction costs as well. But that said, not all changes in implied volatility are caused by changes in the market expectation of future volatility as measured by the VIX. We got interest rates, we got dividends, they play a role as well. Therefore, you have to take these other factors into account when you look at how you might be affected by changes in implied volatility due to the changes in VIX levels. So it's not all cut and dried. So is high or low better? So this answer depends on your strategy and your goals. So generally speaking, when implied volatility is high, it just may mean fewer opportunities because options become more expensive. But on the other hand, low levels resulting from the low VIX levels can present more opportunities because things are cheaper. However, again, it's not always true because there are other factors beyond just the VIX that influence your pricing in the options. So when the VIX is relatively high, we mentioned above 30, it generally indicates that markets are in a state of fear and uncertainty. And investors have become more risk averse. The high levels of volatility leads to increased demand for options contracts, and that drives up the price of premiums. So this means that traders who want to buy options are going to have to pay more for them. Those selling options are going to receive more money. So additionally, that bid-ask spread on contracts, again, it widens when volatility is high and can make trading a little bit more expensive. So traders who are looking to benefit from increased volatility can purchase put options and try to mitigate downside risk by taking advantage of the higher premiums. On the other hand, traders who are looking to take advantage of low volatility can purchase call options or sell puts to capitalize on the cheaper premiums during this time. But ultimately, it's really important because there are other factors beside VIX that affects prices. So traders need to be aware of them as well to make informed decisions. So let's hit some 5 really important facts here. What is the Cboe VIX Index? It's just a measure of expected volatility over the next 30 days. What does a high level of VIX mean? And we talked about over 30. Fear and uncertainty. Higher levels of volatility drives up prices and premiums. So that just means if you're buying options, you're going to have to pay a little bit more for the contracts. If you're selling them, you get a bit more money. Option premiums are affected by the VIX, right? The greater the implied volatility, we could see higher premiums, but that's not the only thing that goes into making up an options price. We also have interest rates, dividends, and the underlying stock price. So you got to take those into account. What strategies to use in high and low? If you're looking to benefit from increased volatility, purchase put options and try to mitigate downside risk. On the other hand, traders are looking to take advantage of low volatility, buy call options or sell puts to capitalize on the cheaper option premiums during this time. And if you're looking to make some money during these volatile times, you're in luck because we have a free guide here and option strategy you can use and profit from the market's up and down movement. It's a free copy. You can download it. The link is beside here and it's in the description. We'll talk to you soon.